What if you could double the impact of your retirement savings? Not only making an impact on your family, but making an equivalent impact on your charities and causes that you care about, or maybe even doubling the amount that you leave to family. Well, tune in because we'll be talking about that today as part of our Financial Power Hour. Hello and welcome to the Hammond Iles Financial Power Hour. And today we're going to talk about 2023 tax planning, strategies that may help you keep more of your income and investments. And so today we're going to talk about some different things, and I encourage you, no matter who prepares your taxes, whether that's you or a paid tax preparer, that the different scenarios that we go over today, that you discuss them not only with a financial coach at Hammond Iles, but also your tax preparer to make sure that you are aware of all tax implications for your personal situation. We will be going over 5 different scenarios and different examples of strategies that could be applied to save you more money in taxes on your income and investments. But it will depend on your personal circumstances on how they apply to you. Our questions are always welcome, and you'll find at the bottom of your screen the opportunity to submit a Q&A or a question. I'll hopefully provide the answer. And then also there is a chat feature. So you're able to chat if you'd like to submit a question throughout the presentation, you can also submit it there. If for some reason we don't have an opportunity to address your question, or like sometimes you finish the webinar and you think of a question, you can always reach out to us at hello@hiwealth.com and we'll be happy to answer your questions. So today we're going to talk about 5 different scenarios related to 2023 tax strategies. The first is that everyone needs a Roth IRA. And I'll tell you a little bit more why I believe that's the case. And we're going to talk about taking advantage of your deductions. It's a little bit harder now that most people use the standard deduction. And so we want to talk about some opportunities there. And then to raise the question, is now a good time to pay taxes? And some people will always say never is a good time to pay taxes. Well, we'll talk a little bit today about some ways to avoid taxes through tax planning, or certainly looking at ways at reducing your tax bill. And then as I started out talking about doubling the impact of your retirement savings, we'll talk about a couple on how they went about doubling the impact of their retirement savings. And then finally, we'll take a look at what might be ahead. So as we think about our tax planning, we can think about what may be coming in the future so that we can plan accordingly today. So let's start out by talking about why everyone needs a Roth IRA. And as an example, I'm going to talk about Emma. Emma is in her late 20s, just getting started in her career, and she's wisely saved up for her emergency savings. And now, in addition to putting money into her employer 401k, is looking at, well, how do I put more money away for retirement? And what I would recommend to Emma is something that I recommend almost to everyone if you qualify. And that is that everybody should have a Roth IRA. And here are some of the basics. So for 2023, you are able to contribute up to $6,500 if you're under the age of 50. And you are able to make a $1,000 extra catch-up contribution if you're over the age of 50. So you can put in a total of $7,500. Now, both of those contributions are after tax, meaning that you've already paid tax on that money, and they're non-deductible. So you don't get any tax benefit at the time that that money goes into your Roth. However, there are some requirements to be able to put that money into your Roth IRA. The first is that the contributions must be from earned income. So if you're retired and you're receiving pension or Social Security, you don't have earned income. It's income that's reported to you on a W-2 form or a 1099 form. However, you can count the income of a spouse. So if your spouse is working, that income can count towards you being eligible for making a contribution to a Roth IRA as well. Now, in addition, there are some phase outs. I find it hard to believe, Congress wants all of us to save more for retirement, but yet there are limitations on who can contribute to a retirement account. So for individuals, that phase out is between $138,000 and $153,000, and for married couples filing jointly, that's between $218,000 and $228,000. So once you exceed the upper end of those ranges, you're prohibited from contributing to a Roth IRA. So also, one of the benefits of a Roth IRA and why I recommend that everybody have it is that the account grows tax deferred until the funds are distributed out of the account. And all of the distributions come out tax-free after having the account for 5 years and after the age of 59.5. And there are no minimum distributions. So with a Roth IRA, the benefit is that it goes in after tax, it grows tax deferred, and then as long as you've had the account for at least 5 years and you're older than 59.5, you'll be able to withdraw those funds on a tax-free basis. And because they come out tax-free, there's no minimum distributions. So unlike a traditional IRA or an employer retirement account that has a minimum distribution requirement, Roth IRAs do not. Now, the reason why I recommended this to Emma and everyone of that is that she was a little concerned. If I put that money into a retirement account like my 401k, I can't pull that back out if I need it. Well, a Roth IRA is different because that money goes in on an after-tax basis. Those contributions can be distributed tax-free without a penalty at any age, at any time. And so that's why I recommend that everyone, if you're eligible to contribute to a Roth IRA, that you do so. And also, you can consider converting a traditional IRA over to a Roth IRA. Again, the investment earnings and growth can be distributed tax-free without penalty after 59.5 and after that 5-year holding period. Now, one of the advantages, and I'll go more into this with some of our additional scenarios that we'll go through, is that it provides diversification for your income planning. If you're in retirement and the only retirement savings that you have is in an employer retirement account or a traditional IRA, you have no option but to draw income from taxable investment accounts. If you have a portion of your retirement savings in a Roth IRA, however, it creates the opportunity to have some diversification. So you can draw how much you want to from that Roth IRA each year on a tax-free basis. Now, you do have that opportunity at any age to convert part or all of your traditional IRA over to a Roth IRA, and we'll talk a little bit more about that as well today. And there is no age limitation on contributing to a Roth IRA. Even if you're over the age of 73, you and your spouse, if you have earned income and you're eligible by those income level phase outs, eligible to contribute to a Roth IRA, you can continue to contribute to a Roth. So if you're working part-time, doing a little bit of consulting, or have some income that you're earning, you have the ability to contribute to a Roth IRA. So that's why we want everyone to have a Roth IRA, is to benefit from those tax savings. Now, the second strategy that we're going to talk about today is taking advantage of your deductions. Now, Sue and Matt, they are a young couple, but are not quite to retirement yet, but are in their earning years and feel very generous with that and making charity contributions of around $15,000 per year. The challenge is that when we look at itemizing tax deductions, even with that very generous donation to charity, what they find is that the standard deduction for a married couple filing jointly for this year is $27,700. So that charitable contributions, unless they have a substantial amount of real estate taxes that they can deduct, although those are limited as well under current tax law, they fall under that standard deduction. So how can they be charitable and take full advantage of that for tax purposes? And it's through a strategy that we call bunching. And bunching is when you take deductions from basically multiple years and you bunch them together into a single year. Now, you may have experienced that if you just deferred paying your property taxes one year into January. And so you had a single year where you paid in January, July, and December. You had 3 payments instead of the normal 2. That's a form of bunching. But unfortunately, as I mentioned, under current tax law, property taxes are limited on how much you can deduct. But charitable deductions have some limitations as a percentage of your adjusted gross income, but beyond that's a fairly substantial amount. So one of the ways that we can bunch deductions for charitable giving is through what's called a donor advised fund. So a donor advised fund is a fund that is typically held by a community foundation or a nonprofit foundation on your behalf. And you put money in or investments in, you contribute to it, and you get a full tax deduction at the time that those funds go in. Now, once inside the donor advised fund, you have the ability to manage the investments with an investment company like Hammond, Iles Wealth Advisors, where we can manage that in a diversified portfolio for growth. And you have the flexibility to pay that out to as many nonprofit organizations as you choose. Typically, there's a minimum dollar threshold as to what they'll cut a check for, but otherwise, as long as it's going out to a 501c3 organization, you can pay that out. So if we take a look again at how Sue and Matt, and the nice thing is you can name the fund to be whatever you want it to be. And so in this case, we're just calling it Sue and Matt's Amazing Impact Fund that they created. And instead of contributing the $15,000 that they normally contribute on an annual basis, they're going to bunch it. So what they're going to do is instead contribute 3 years worth of donations into the donor advised fund at one time. So what does that do? So for their tax return this year, instead of reporting just the normal $15,000, they'll be reporting the full $45,000 or whatever that amount may be as a charitable deduction, even though it's not being paid immediately out to those charitable organizations. So it allows them to take that immediate deduction and exceed the standard deduction where they can have a much larger deduction in this year. Now, some other circumstances where that may come into play is if you happen to receive a bonus. Are you retiring and you're getting all of your sick leave paid to you as an extra bonus, or there's a severance package that contributes a larger amount to you, so you have this larger spike in income in that year. You can use some of that and offset some of that higher income through a donor advised fund by bunching again the charitable donations. Another way of doing that is through appreciated investments. So rather than just writing a check, you might be saying, well, I don't have $45,000 in my checking account, but I do have after-tax investments that have appreciated in value. I can send those into the donor advised fund and get a charitable deduction for the full market value of the investments when they go into the donor advised fund. An advantage of that is you are able to sell those investments inside the donor advised fund without recognizing capital gains. So you kind of get a 2-for-1 deal there. You get the charitable deduction and you avoid the capital gains tax. So there's a lot of benefits of doing that with a donor advised fund. Now, once those funds are in the donor advised fund, then what we do is you either go online or send an email notifying the donor advised fund that you want to pay some of that money out. So then those checks are written out to those nonprofit organizations and your donations go out. The nice thing about a donor advised fund is that there is no requirement that anything has to be paid out in any year. You have complete flexibility. You could put in $45,000 and just let it sit there and grow inside the donor advised fund. Or you may say, well, I want to keep the principal in there and I'm just going to give away the growth. Now, part of the setup of the donor advised fund is that you do make instructions as to what happens to it upon your departure from this earth. Does it carry on with your children? Do they then take over the fund and be able to continue the charitable giving? Or does it just disband and pay out the remaining balance to the organizations that you choose? You have that choice. So here are some of the things and benefits about bunching charitable deductions with a donor advised fund. The first is that you can claim that larger charitable deduction in a single year. So you have that $45,000 instead of the $15,000 that Sue and Matt would normally have on an annual basis. Now, once that happens, that means certainly that years 2 and 3 after that, they're not making charitable donations, so they don't have a deduction. So in those years, they just use the full standard deduction. So they get the benefit of all of their charitable giving in 1 year and then just use the standard deduction in the 2 years after that. And they can repeat that cycle over and over again. And you can do the same if you have repeated bonuses or things that are paid to you where your income is higher in certain years. It's a great way of helping to offset that higher income and kind of put some money away for future charitable giving. The other advantage of a donor advised fund is that you only have one donation letter. This time of year, we're all searching for our tax records to prepare for our tax return preparation. And if you give to multiple organizations, you have to find multiple records of that to put that together. With a donor advised fund, even though you may be giving to 10, 20 organizations, you only need to have just one donation letter of those funds when it went into the donor advised fund. As I mentioned earlier, you also avoid capital gains, so you're able to diversify your portfolio. So if you have a single stock, for example, that you've held for a long time, has substantial capital gains, you can donate shares of that stock into the donor advised fund, sell them there with no tax consequences, and then reinvest in a broadly diversified portfolio. Because you have complete control over how those funds are invested inside the donor advised fund. Now, also, as I mentioned earlier, the balance can stay in there. You're not required to make any distributions in any year. It's completely up to you. And you can pay out to multiple organizations and causes. So this is a great way to bunch your deductions to take advantage of your charitable giving. No matter what level of charitable giving that you make, it's a great way to kind of pre-fund that and take advantage of that tax-wise. Now, as I mentioned, whether you're donating investments to a donor advised fund, or if you're just making a donation to your church or favorite organization, you should also be looking at tax advantage gifts. Most people think, well, a gift to a charity is just a cash or a check or Venmo or whatever form of payment you're using today. However, when we look at our overall net worth, really only a small percentage of that typically is cash. Most of it is in investments. So we should be using those appreciated investments to make those tax advantage gifts. So you make one gift and you save twice. So consider donating those appreciated investments to your charity when you're making a gift. And here's just a simple example. So if I purchased a stock back in May of 2015 and I invested $20,000 in it, and the stock market has done well over the last 7 years. There's been some hiccups, but overall, that stock may have grown to $45,000. Kind of just like Matt and Sue on making their gift to their donor advised fund. Now, if they gifted that stock, they have $25,000 of unrealized capital gains. So if they sold the stock and then paid the cash to charity, they would pay tax on that $25,000. And depending on their level of income, that could be anywhere from 0 to 15 to 20% on a federal tax basis, and then state tax on top of that. So by gifting the stock directly to a nonprofit organization or to a donor advised fund, you get a tax deduction equal to the full market value. So in this case, it would be that full $45,000. You also have that additional savings. There's no capital gains tax on that appreciation that's built up inside that stock. And then lastly, if you do put it inside a charitable fund, you can diversify. So if you have a stock that you inherited or that you've held for a long time and has substantial gains, it's a great way to diversify your portfolio. Now, for those of you that are over the age of 70 and a half, another form of donating appreciated assets is what's called qualified charitable distributions, or QCDs. And it's for individuals over the age of 70 and a half. They can donate up to $100,000 per year from an IRA directly to a 501c3. And I just want to mention here that it has to be from an IRA. So if you have a 401k, a 403b, or another employer retirement account, you're not able to use a QCD directly from that employer retirement account. You would have to roll either part or some of that money over into an IRA and then make the charitable gift from there. Now, the benefit of a QCD is that it's not reported as taxable income. So if I give $10,000 to a charity from my IRA, it is not reported as income. It just, the full $10,000 goes to charity. There's no taxes to me, but I also don't get a tax deduction for that charitable contribution. However, if I'm over the age of 73, which is the new age in 2023 to require minimum distributions, it does count towards my minimum distribution. So if you find yourself in the situation that you don't need your required minimum distribution, or if you're charitable at all, use your required minimum distribution from your IRA to make charitable donations. Even if you need that money for income, keep the cash that you have in your checking account that you would have contributed to the charity for yourself and donate the taxable money to the charity. Now, effective this year, as part of the Secure Act 2.0, which, by the way, if you did not see our workshop that included information about Secure Act 2.0, go to our channel on YouTube, just search Hammond Iles at YouTube, and you'll find our workshop that includes talking about Secure Act 2.0. But one of the provisions in that is that now, in addition to giving up to $100,000 a year to charity, you're also allowed a one-time, once-in-a-lifetime donation of up to $50,000 to what are called split interest entities. And that can include a charitable remainder trust or even a charitable gift annuity. So if you're looking for a way to make an impact on a charitable organization and create more retirement income for yourself, a charitable gift annuity can be a great way of doing it. So by sending that $50,000 from your IRA to a charity that offers charitable gift annuities, it allows you to create a lifetime income back to you, and the remainder then passes on to your charity of choice. If you'd like to learn a little bit more about that, just go to our website at hiwealth.com, and in the top right corner, you'll see a button to click on to schedule a free 15-minute conversation. We'll be happy to go over this or any other of the strategies that I'm talking about today. And then also in 2024, that $100,000 limit is going to be increasing for inflation. So this can be a great way of giving money on an after-tax basis, or on a pre-tax basis, to a nonprofit organization. So we've talked about everybody should have a Roth IRA. We've talked about how to bunch your deductions and take advantage of the deductions for you. Now I'm asking the question, is now a good time to pay taxes? And you may be saying, it's never a good time to pay taxes. Well, I want to talk to you a little bit about just some things that are on the horizon that we need to look at, and whether it makes sense that if we do have taxable assets, does it make sense to do some planning for those assets? So here are some of the challenges that are on the horizon. The first is that the Congressional Budget Office recently projected that the Social Security trust funds are headed for insolvency by 2033. Now, I just want to be clear, by what we mean by insolvency doesn't mean that the benefit will go away. It just means that there's no longer a cash cushion in the trust fund. So they will have to reduce benefits to equal what's coming in from payroll taxes. So that is what's on the horizon. And so does that mean that taxes may have to go up to help fund that? Congress is also currently debating whether we should be raising the debt ceiling, which is currently at 31.381 trillion with a T US dollars. And that will probably cause some volatility in the financial markets as we approach that deadline. So the question is will they raise it? And if they do, what will be the consequences to accomplish that? Will they raise income taxes or reduce spending? One way or another, the US government needs to look at ways of balancing the budget or coming close to that. Now, as we look at rising interest rates, which over the last year, interest rates have raised multiple times the fastest amount in recent history, where the US government has kind of been spoiled by the fact that they've been able to borrow these trillions of dollars at a very low cost. That's not going to continue. And that actually one of the fastest growing expenditures over the next decade will be the interest that will be needed to be paid on that national debt. And the CBO, or the Congressional Budget Office, estimates that that will amount to $10.5 trillion over the next 10 years. And that's just the interest. That's not even paying down the principal. And by the end of that decade, that means that we'll be paying more interest than we're spending on the defense budget. So there are some really strains that are coming up that could cause Congress to look at ways of raising taxes or reducing spending to help offset that. Now, one of the other things that doesn't really apply to Congress, although it was passed by Congress back in 2019, is the original Secure Act. One of the things that was put into that legislation is that the stretch IRA for non-spouse beneficiaries has been eliminated. Now, that may not mean a whole lot to you, and you might be saying, well, I'm going to just live my life and let my kids deal with whatever happens in the future. However, you may want to look at ways of helping out your future legacy that you leave to those family members. Now, a stretch IRA, for those of you that may not be familiar with that term, is what used to be available to children and other non-spouse beneficiaries. Is when you inherit an IRA, you could leave the money invested in the IRA account, take out a minimum distribution each year, and stretch it out over your lifetime. And there's the possibility that you could ultimately then stretch it out, pass it on to your children or beneficiaries, and stretch it out even further. And the federal government, one way of funding this deficit, has passed a law to kind of shorten that time frame. So under current law, under the Secure Act, Non-spouse beneficiaries will be required to take out all of the retirement savings that they inherit within a 10-year period. There's no stretching beyond that 10 years. And so they'll need to take that all out. So if you have $1 million IRA, for example, your non-spouse beneficiaries, if they pay that out over 10 years, will have $100,000 or more with the growth of it each year as additional taxable income, which if it hits them right in their prime earning years can be a substantial loss. And that those retirement savings that you have spent so long on saving could be drastically lost to taxes, especially if we see tax rates go up in the future. So how do we plot against that? And before I go into some of those strategies, I just want to reflect back and take a look at the highest federal income tax rates over history. Going back to 1913, what we see is that rates actually got as high as over 90% at one point. Now, at the present time, the highest tax rate is 37%, although you could be a little bit higher, just under 40%, with some additional tax that is added on to investments. But the highest marginal tax rate right now is 37%. So if you ask the question, do you believe that that is going up in the future, or is it going down? Because when we take a look at your retirement savings, which primarily, unless they're in a Roth IRA or a Roth 401k, are pre-tax, we want to look at how do we minimize the tax. So really our conventional wisdom is we want to pay taxes, if we have to, at the lowest rate possible. So if we believe that the expected tax rate in the future will be higher, then it makes sense that we may want to look at converting our retirement savings to a Roth IRA, because then the growth and the future earnings on that will come out tax-free. Now, if tax rates are the same, it may be indifferent between traditional and Roth IRA, although I'm going to point out a few things that I think will tip the scales in favor of a Roth IRA. And certainly if you're working in a job where you have a high income and you anticipate having a lower income lifestyle or the ability to have lower taxable income in retirement, or you think that taxes are going to go lower, then keeping money in a traditional IRA or an employer retirement account would make sense. Now, beyond just looking at tax rates, whether they're going up or going down, it's also important to look at some other factors in the decision on whether it makes sense to convert part or all of your IRA to a Roth IRA. The first is that Roth IRA distributions can help reduce taxation of your Social Security. And this is one of the things that most people don't pay attention to. And I'll go over an example of that in just a minute. And also, as I mentioned earlier, Roth IRAs have an opportunity to diversify your income. Now, also, we just happen to be at a point where the financial markets are lower than they have been in the past. So because of that market volatility, and we have lower account values, it may be an opportunity to convert at a lower account value. Because if you take that 100 shares of your investment and you slide it over to a Roth IRA, you're taxed on the value of those shares on the date that it converts over to the Roth. But you still own those 100 shares of that investment. So going forward, if the markets continue to grow as they have historically done, then that growth will be inside the Roth IRA and not building up more taxable income inside the traditional IRA. The other two aspects are legacy building. The advantage of a Roth IRA, because it is after-tax money, is that there are no minimum distributions. So just by the fact that you don't have to take money out of those accounts can allow you to build your wealth that you pass on and transfer to the next generation. Also, it reduces the income tax liability to your beneficiaries. Even if they have to take it out within that 10-year time frame, it comes out to them on a tax-free basis. So let's take a look at Mike and Barbara. Mike and Barbara are a couple that are age 60. They're currently working and have a household income of $100,000. And Mike and Barbara plan to retire at the age of 66. They'll be at their full retirement age when it comes to Social Security, and they plan to maintain their level of income. They want to maintain their lifestyle. So they want the same $100,000 of income. So taking a look at what they expect to receive from Social Security, they're expecting to receive around $46,000 a year. So that means that they'll need to draw around $54,000 a year from their retirement savings in order to maintain their level of income. So the question then becomes, what would be the difference between having a traditional IRA versus a Roth IRA? And how much of the Social Security benefits will be taxed from those withdrawals? So let's take a look at the difference here. So if all those funds come out of a traditional IRA, they have the $46,000 from Social Security, take $54,000, those distributions are taxable. Now, we all know that the $54,000 are taxable coming out of the traditional IRA, but did we really think about the fact that now that triggers taxes on the Social Security? Because when you earn over $25,000 as an individual or over $32,000 as a couple filing jointly, you'll pay up to 50% of, pay tax on up to 50% of your Social Security benefits. If your income outside Social Security exceeds $34,000 as an individual or $44,000 as a couple, then your Social Security could be taxed up to 85% of it. So in this case, taking a look at a couple where we're just using the $54,000 from the IRA withdrawals, not including any other interest or dividends or anything else that they may be earning that's taxable, that would trigger $34,000 of the $46,000 of their Social Security to become taxable. They still have $12,000 just under that that's not taxable, but by taking that $54,000 out of their retirement accounts, they're not only going to pay tax on that, but they're also going to pay tax on an additional $34,000 of their Social Security. Now, what if they planned ahead at age 60 and they converted that IRA over to a Roth IRA? So now they're getting that same $100,000, 46 from Social Security, 54,000 from their retirement savings. However, coming out of the Roth IRA that they've had for at least 5 years, and they're over age 59 and a half, there's no taxation. And because that's not taxable, they have no taxable income outside of Social Security, so none of their Social Security is taxable. So in one situation, they're paying tax on $34,000 of their Social Security. In the other situation, they're paying none. And that's a fairly substantial tax savings. So when we're looking ahead at using a Roth IRA versus a traditional IRA, one way to look at it is the way that it benefits you in reducing taxation of your Social Security benefits. Now, one of the other impacts is on their minimum distributions and being able to grow the legacy that they're going to pass on to their son. So Mike and Barbara, fast forward, we're now at age 73. They realize that they don't need all of their retirement savings. You know, they still want to make sure that they keep enough there for providing for themselves, but they realize that they're probably not going to need to tap into all of it. So they want to look at leaving a legacy to their son. So Mike takes a look at converting $200,000 of his IRA to a Roth IRA. Now that may be the entire IRA, it may be just part of it. You can do as much or as little as you would like to convert. Now, in this example, we're just going to make the assumption that Mike pays the income tax on the conversion out of the conversion. So to use simple math, we're going to just say for federal and state taxes, he pays 25% in income taxes. So on $200,000, that means he would owe $50,000 of income taxes. Now, usually when we make a conversion, the ideal situation would be to pay that tax outside of the IRA, but just to keep things simple, we're going to assume that he pays it. So what that means is that he pays the income taxes during the conversion. So he starts with $200,000, he ends up with $150,000 in his Roth IRA. Now, for the purpose of this hypothetical illustration, we're going to look at the fact that taxes total 25%, that the growth of their retirement investments are in a diversified portfolio, and it just averages a 6% annualized return across all of their lives, including their son, and that their required minimum distribution is taken out on the first of the year, just to keep things simple. So let's take a look at what happens during Mike's lifetime. So Mike ends up living to age 78, so he has 6 years of taking minimum distributions, and starting at age 73 ends up taking out $39,118 after tax. So he actually took out more than that. That's after the taxes have been paid. And so calculating at that 6% annualized return, he ends up at his death with an IRA worth $220,000. And again, it's an IRA, so it's all pre-tax money. Now, if he had converted to the Roth IRA, he started with $150,000. Again, because it's a Roth IRA, there are no minimum distributions. So since he doesn't need anything from that portion of his retirement savings for lifestyle, it's just allowed to grow. There's no distributions, no RMDs required. So at 6%, that $150,000 over those 6 years grows to a compounded just under $213,000. So a little shy of where the traditional IRA, except that $212,778 is after tax money, whereas the $220 still owes tax. Now, upon Mike's death, he put his wife Barbara as the primary beneficiary, and so she steps in as the spouse beneficiary and just takes over the IRA. Now, Barbara herself lives for another 9 years and ends up passing away at the age of 87. And during those 9 years, the minimum distributions that she takes out, again, on an after-tax basis, is around $86,000. And surprisingly, because of her age, those minimum distributions start eating into that growth, that the growth of the 6% is not significant enough to keep up with the distributions that have to come out. So at her death, she actually ends up with less in the IRA, just over $218,000 than where she started 9 years earlier. However, again, on the Roth IRA side, there's no minimum distributions, so she can just let it ride. And at her death, that account is now estimated to be worth $359,000. So you can see now that compounding, especially now that it's on an after-tax basis, is a substantial difference. So now let's take a look at Mike Jr. Mike Jr. inherits Barbara's IRA, and as a non-spouse beneficiary, he rolls that over to an inherited IRA. And because of that Secure Act, he's required to take the account balance out over 10 years. Now, if that money is in a traditional IRA and he is earning a good income, he doesn't want to take out that amount as a lump sum, so he stretches it out over 10 years. And one way to do that is you just divide the account balance by the number of years left. So in year 1, he divides by 10. In year 2, he divides the balance by 9, and so forth, until ultimately in the last year, he just takes everything out so that it's all out in the 10-year time frame. So over that time frame, he would have actually, even with 6% growth, would have received after taxes around $216,000. So if you're doing the math and you're adding it up between both Mike Jr. as well as both Mike Sr. and Barbara, what they've received over that time frame is roughly $341,000 after taxes. Now, on the other side, he inherits the Roth IRA. Now, again, because a Roth IRA comes out tax-free, there's no urgency to get that money out during the 10 years. So Mike Jr. allows the Roth IRA to grow for the full 10 years. And then in year 10, he takes out the entire account balance because he has to by that Secure Act 10-year rule. Now, growing again, still at 6% per year, that Roth IRA, when he takes the money out, is worth $643,000. So when we take a look at what the parents and Mike Jr. took out during their time frames from the traditional IRA, they ended up with an amount almost $300,000 less because of all of that growth over those years coming out as taxable income rather than tax-free out of the Roth IRA. So this can be a tremendous strategy for maximizing a legacy to your family members. So you may want to consider, is there part of an IRA that you want to look at converting over to a Roth IRA? Even if you need to tap into that during your lifetime, it can still end up potentially leaving a larger legacy to your family members. Now, some of the things to keep in mind with a Roth IRA conversion is that converting, whether it's part or all of your IRA, it may bring you up and over the next income tax bracket. So if you convert 100,000, or in this case, this example, 200,000, that may push you into a higher tax bracket. So we want to be aware of that. If you're under the age of 59.5%, normally distributions out of retirement accounts require a 10% early withdrawal penalty. Be aware that if you convert an IRA to a Roth IRA, the 10% early withdrawal penalty is waived on any converted assets. However, if we, like our example, tapped into the IRA to pay the tax on the conversion, that is not waived from the 10% early withdrawal penalty. So if you're under 59.5, you most likely want to only convert the amount that you can afford to pay the tax on outside of the IRA. Now, the conversion must happen each year on a calendar year basis. So it's not like contributions to retirement accounts where you have up until the due date of your tax return, typically April 15th. And as I have said several times, conversions are most effective if you're paying the income taxes outside of that. And it's always, always important to avoid a surprise of unexpected taxes. I do not want to get a call from you on April 1st saying that you owe taxes with your tax return. It's important anytime we take action on something like a Roth IRA conversion that you know the tax consequences in advance before you convert it, and that you consult your tax advisor. Now, we talked about doubling the impact or looking at paying tax now. I started out today talking about doubling the impact, and certainly in the example that we just talked about, Mike and Barbara and their son, Mike, we actually ended up doubling the impact of the retirement savings just through conversion of their IRA to a Roth IRA. But I'm going to show you another strategy that will eliminate taxes altogether. So where we just talked about how do we reduce taxes, there's strategies that we can use where we can eliminate taxes. And so for this example, we're going to look at Arthur and Michelle. Now, Arthur and Michelle are both age 73 years young. Arthur has $1 million IRA, and now that he is 73, he needs to start taking his minimum distribution. However, thanks to a pension that he has, as well as Social Security, Arthur and Michelle don't need the minimum distributions for income. So in talking to them, they wanted to leave a legacy for their family. They obviously wanted to pay as little income taxes for themselves and their children, and they wanted to make an impact on their favorite charities. And so we implemented this strategy that we refer to as double the impact of your retirement savings. So what does that look like? So Arthur has the $1 million retirement account, and your retirement account could be a lot less, could be a lot more, but this is a nice round figure just to give you an example of how this strategy works. So from that, as I mentioned, at age 73, he has to take the minimum distribution out. So he has to take out $37,736 at age 73. And from that, assuming that he has a 22% federal tax bracket and 4.6% here in Connecticut, he has to pay a little over $10,000 in income taxes. So from that, part of the strategy is we use part of the amount to buy a life insurance policy. And this policy is what's called a second to die life insurance policy, meaning that it's insured over 2 life expectancies. So it tends to be less expensive, but it does not pay the death benefit until the second spouse passes away. So when Arthur and Michelle pass away, when they both pass, $1 million will be paid out to their beneficiaries. The benefit of life insurance is that it is income tax free. So rather than receiving $1 million in a retirement account, which they would have to take out over a 10-year time frame and pay income taxes on, they get a full $1 million tax-free. And if your estate is large enough that you're subject to estate taxes, there are ways to own that life insurance to make sure that it's outside of your estate. Now, even with this, they also have a little extra left over, so they can take an extra trip or spend a little bit more on the grandkids, so they can do what they want to do as well and splurge a little bit from that minimum distribution. And one of the things, though, to mention also about that is that that is a guaranteed universal life policy, so that premium does not change. That will stay the same. So even though over his lifetime or over Michelle's lifetime, that minimum distribution will get larger and larger every year, the premium that is paid will not. So that's for the family members. Leaving the legacy is the life insurance. We have $1 million tax-free. We know no matter what happens, as long as that premium gets paid, the kids and the family members will get $1 million. But that still leaves the $1 million IRA. The account continues to grow. And when Arthur passes away, if he predeceases Michelle, she will inherit the IRA as the primary beneficiary, and she can continue the same process, taking minimum distributions and paying the premium on the life insurance. But then they've named their charities as the contingent beneficiaries. So ultimately, when both of them pass, the charities will receive 100% of the retirement account value income tax free. Now, that may be the $1 million, it may be less, it may be more, depending on how the investments grow over those years. But now we've gone from $1 million of a taxable retirement account to $1 million tax-free to the family members, and potentially $1 million or more to charity. So we've now doubled the impact of the retirement savings, and we disinherited Uncle Sam. So it's a way of eliminating those income taxes after death for the family members. So double the impact of your retirement savings can be a great way of doing that. Now, just briefly, as we wrap up, a look at what might be ahead. We talked about the challenges that we're facing and that there may be a requirement for Congress to look at ways of filling a hole in the budget, as well as paying down our national debt. There are also things that we have to be aware of. One is that required minimum distribution age, it increased this year with the Secure Act 2.0. And again, we have a separate presentation that you can see on that. It goes up to 73 this year. And then for those born after 1960, starting in 2033, that minimum distribution age will go up to 75. Now, also some things that could be future possibilities is that there could also be changes around capital gains taxes. So in addition to paying attention to what might be happening with income taxes, we also have to be aware of capital gains taxes. And there's already proposals being made to raise capital gains taxes to the ordinary income level for some taxpayers. If that's the case, then we want to pay attention. Does it make sense to possibly sell appreciated assets now to recognize the capital gains while the rates are lower than in the future? Also, unless Congress acts, the 2023 federal let me say that again. So unless Congress acts, the 2023 federal estate tax exemption, which for this year is $12.92 million per person. So a married couple can leave close to $26 million without any estate tax. That current law sunsets at the end of 2025. And what happens is that the tax law will automatically, if Congress does nothing, revert back to 2017, which at that point was a level of about $5.5 million per person. Now, you may say, well, I'm underneath that, so I don't have anything to worry. But also Congress may say, well, we need to close that deficit and pay down our debt. So we're going to reduce that estate tax exemption even more. We'll have to wait and see, but it's something that to keep an eye on for the future. So at this point, I just want to take a break. If you have any questions, you can type those into the webinar chat or into the question and answer area. I'll be happy to answer any questions on what we've covered today. Well, either you're still drowning from the fire hose of information we shared with you today, or you haven't thought of a question that applies to those situations yet. But again, if you need information, or if you would like to ask a question after the webinar, please reach out to our firm, call our office to schedule a time, or email us at hello@hiwealth.com. We'll be happy to address any questions. Speaking of which, one came up. Carol asked the question, can a conversion to a Roth IRA count as your RMD? That's a great question, Carol, and the answer to that is no. And actually, if you are looking to make a conversion from an IRA to a Roth IRA, and you're age 73 or older, where you are required to take a minimum distribution, you actually have to satisfy that minimum distribution this year before you can make the conversion. So not only does the Roth conversion not count towards the minimum distribution, but you have to satisfy it before you make the conversion. And another question was, in the example of purchasing the universal life policy, there is a yearly cost of the $25,000 premium. And yes, that would be a $25,000 annual cost. Again, that's just an example, depending on your age at which you put that policy in place. That strategy does not have to wait until you reach age 73, where you're subject to minimum distribution. It can be started earlier. You can still take distributions from the retirement account to cover the cost, or pay the premium outside of your retirement accounts until the minimum distributions kick in. So depending on your age and your health evaluation, those premiums could be much lower or could potentially be higher. But that strategy, we can go through the process of calculating the amount and getting an illustration for you to make that determination at no commitment to it until we go through the process. So great question on that. So thank you for those questions. That was a great question. So a lot of these questions can be answered in a meeting with your financial coach at Hammond Iles. Again, if you have any other questions, please email us at hello@hiwealth.com. Also, a recording of this webinar will be emailed out to you if you registered, and it will be available for you and anyone that you think would benefit from it on our YouTube channel. So until next time, we hope that you and your family have good health and good fortune and live a life of purpose. We are here to make a meaningful difference in our clients' lives by empowering families across 3 generations to live a life of freedom and fulfillment. So we continue to hope that you join us on a monthly basis for our education workshops. And until then, be well, stay safe, and we'll see you soon.